Hey guys, welcome back to the channel and good morning to all of you. So let's begin the Q2FY26 analysis series with defense sector stocks, and we'll do analysis of further two stocks from the other sectors in the end of the video. But let's analyze the जितने भी सारे डिफेंस वाली कंपनीज जो हम लोग ट्रैक करते हैं वो let's compare the results of those companies. So let's start with the data pattern. I think this is the third show we are putting on this defense sector stocks, and some of good companies we have found in the last quarter also. And let's begin with this data pattern. So this is company who has posted almost around 307 crores of the revenue in Q2 FY26, which is almost like 238% growth. So this growth is humongous, but the issue with this company is that the growth is not consistent basically. So last quarter it was negative, now this quarter it is triple digit growth, 100% EBITDA growth, which is lower than what the sales growth is. If you look at the EBITDA margin, it is declining from 38% to 22%, right? So I'll tell you the reason for that. Then there is PAT growth of only 63%. So there is no operating leverage basically this company has got, with decrease in the PAT margin from 32% to 15%. Now, if you see here, the Q2 margin is reduced. The reason is that company is saying that the Q2 margin are deliberately reduced in order to meet the large order, which is large electromechanical system order having 140 tons of material, and they accepted this order just to engage with the customer and just to gain more customer. That's what they are saying, and because of that the margins are lower here. Order book stands at around 673 crores. There are almost like 350 crores of order inflow in the first half, and another 1000 crores of order inflow expected in the second half. But if you see, although the company has grown at around 238% in the Q2, the overall guidance is not increased, it is not revised. It says 20 to 25% guidance. So that is one concern for me for this particular company. So uh, if you see here, FY25 they grown at around 36% in the last year, but this year they're targeting a growth of around 20 to 25%. That means what? The pace of growth is definitely declining here, and that is the concern for me. If you calculate the forward P here, it comes out in the range of 61 to 65, with a growth engine of 20 to 25%. Expected sales around 885 crores, and expected PAT around 282 crores. So I have assumed PAT margin of around almost 32% here. So the bottom line here is that inconsistent revenues and the PAT guidance, inconsistent revenues and definitely the PAT, and the guidance of 20 to 25% maintained, although they grown at around 238%. So this is all about data pattern. So the next company is Rossell Tech System Limited. So this one has posted a revenue of around 125 crores, which is almost like 145% growth in the revenue, 200% growth in the EBITDA. That is fantastic. Then EBITDA margin almost stabilizing at around 12%. Uh, Exponential increase in the PAT, because last year, year on year, if we compare, there was negative profit. So exponential increase in the EPS along with the so PAT margin is 4.5%. Now, what has happened here? If you compare, last time we discussed Q1 results, and we discussed that there is almost like revenues were doubled in the Q1, with increase in the EBITDA margin, increase in the PAT margin. That's what we discussed, right? Uh, and in the Q2 again, the revenue like doubled more than two times, the 2.44 times increase in the revenue. And company has described this quarter as exceptionally significant and historic quarter, with EBITDA margin, like they're saying that for Q3 and Q4 it would be around 15 to 20% increase in the EBITDA margin. So right now EBITDA margin is 12%, but what they are saying is that basically Q3 and Q4 are going to be bumper for this company. If you see the confirmed purchase order from the order book, almost around 720 crores, and long-term contracts they have secured almost about around 2500 crores. So if you look at the business model of this company, they are into defense and military aerospace, then space and semiconductor. That's how their bifurcation is, and what they're saying that semiconductor domain has ramped up significantly, so that will add into the revenues. So in the first half they did almost around 212 crores, and expected revenue for full year is around 400 crores. initially when we did the Q1. Now it seems that they could do more than 400 crores. That means 400 crores plus of the revenue is possible, which comes around 53% year-on-year growth. And the expected PAT, which we calculated previously in the Q1, was around 16 crores. But based upon the new numbers, it appears that PAT also could be in the range of 25 to 30 crores. So what we are looking at here, because of the improved numbers, is that the forward P may range from 84 to 101. So that is a growth engine of 53% plus. It could be more than 53% also. And what I'm observing here is that the best case, that means the forward P of 84 is likely here, since uh, they are targeting more EBITDA. That means EBITDA is moving from 12% to 15 to 20%. So right now 84p is based upon 15% EBITDA only. So if you factor in 20% EBITDA, this p could be much lower than 84. And that's why this case is very very interesting. And because of the fantastic Q1 and Q2 and the super fantastic Q3 and Q4 expected by the company, this is a good growth engine. So let's now talk about the next company, that is Garden Rich Shipbuilders. Now this company is in a business of making ships basically. So they posted a growth of around 1667 crores in the Q2 FY26 with a 45% growth. So growth looks solid, with EBITDA growth of around 56%. EBITDA margin is also increasing from 6 to 9%. 57% PAT growth, and PAT margin is also improving. So every box is ticked here. So what is the issue here? This particular company, if you see, they describe Q2 FY26 as an encouraging quarter, with order book which is standing at around 20,000 crores, almost 20,000 crores plus. And majority chunk of this order is from defense, and 17% is from non-defense platform basically. So the target is to close the order book at the end of FY26 by almost like 50,000 crores. Now they have given updates on their several projects here. So almost like five projects are here, and they have delivered some of the ships from these projects already, and they are on target to deliver the remaining deliveries on time. So you can pause this and read and go through this each of the projects which I have mentioned here. Now, what is the guidance? Basically, that's what I'm looking for. In FY26, they're guiding for 25 to 30% growth. So if you see in the Q2, they delivered almost like 45% growth. But overall annual basis, company has not revised the guidance to the upside, but they are maintaining the guidance of 25 to 30%. So if you see FY25, they grown at around 41%, but now in FY26 that they are growing at around 25 to 30%. So that is one concern. So they're also into the capacity expansion. They want to increase the capacity or shipbuilding capacity from 28 ships to 32 ships by the end of FY26. And there are some future opportunities also where they can bid and gain the orders basically. So that is given, but overall the pace of the growth is falling. So if you see the forward P here, it comes around in the range of 60 to 63, with a growth of around 30%. Expected sales 5,700 crores, and expected PAT of around 500 to 520 crores. That's what I'm seeing here. Now, how do you describe Q2? Q2, you have to see that Q2 FY26 is like a marathon runner who runs very fast in between. Like in Q2, this company has run very fast, like 45% growth. But at later time point, the growth may get slowed down, and that's why overall annual growth is around 30%, not 45%. So that is one. So this is all about Garden Rich Shipbuilder. Now moving on to the next company, which is Krishna Defense. Now this is in the again ship. It manufactures the components for the ship. Did almost around 120 crores of the revenue. And if you see the pace of the sales growth, this company used to grow at around 168%. Now it is growing at 28%. See, so that pace of growth is already falling, and there is EBITDA growth of 53%, EBITDA margin from 15 to 17.9%. It is good, but overall pace of the growth is falling here. PAT growth is 71% with improvement in the PAT margin, that is 11% to 15%. Now, what is the first half 26 closing order book is almost like 195 crores. And they've also inaugurated autonomous underwater vehicle facility, and they're also focusing on the indigenous defense manufacturing and shipbuilding products. So you can pause the video here and to understand the business model, because I already explained the business model in detail in the previous video. So I'm not going to go through each and every component here. But what company's guidance is basically 30 to 40% CAGR over a period of next 3 years. So if you see the growth rate, which used to be triple digit, now it is 25 to 28%, and forward P comes around 35 to 40 with expected sales of around 240 to 250 crores and expected PAT of around 35 to 38 crores, assuming 15% PAT margin. So this looks reasonably valued, but the pace of the sales growth is falling here, and that's why that is the major concern for me for Krishna Defense. Now moving on to the next interesting company, that is Apollo Microsystems Limited. Uh, did almost around 225 crores of the revenue with 40% growth. So this growth is consistent with the last quarter. So that is good point. 79% EBITDA growth, with improvement in the EBITDA margin by 6%. Then PAT growth 106%. So they got operating leverage with improvement in the PAT margin, that is from 9.9 to 14%, which is good. And also the EPS growth. So every box is ticked. Now what is happening here in Q1 FY26, we saw 46% growth with improvement in the EBITDA margin and PAT margin, right? In Q2 FY26, we saw again 225 crores of the revenue with 40%. So highest ever quarterly revenue and PAT this company has observed. In first half, almost they did around then 359 crores of the revenue. In second half, they can do 360 crores plus of the revenue, because order book in front of them is around 785 crores, and FY26 expected revenues is around 800 crores. So it comes around 45 to 50% of the year on year sales growth. Now whatever the promoter pledge is there, promoter intends to close all the pledge shares within next 6 months. So that is good news for the investors. Now, if you see this company, we have discussed that this company has acquired ILD Exclusive, which was EBITDA negative when they acquired, and it intends to be EBITDA positive by the end of Q2 FY26. But actually, company is now saying that by Q2 FY26, ILD Exclusive, which will be PAT positive. So this company will add synergy to what Apollo Microsystem has been manufacturing. So there will be definitely a synergy. Now in the Q1 FY26, they said that EBITDA margin will be moderated in the second half, but there is no signs of such moderation is being observed in the Q2 FY26 commentary. So it seems they are confident in maintaining the EBITDA margin, and that's why the expected sales comes around 800 to 850 crores, and expected PAT comes around 90 crores, which is 10%, almost 10%. मैंने पकड़ा है 10 to 15%. If I see, then it comes around 119 crores. So forward P comes around 79 to 105 with a growth rate of around 40 to 50%. So we have to look for this one, that the EBITDA margin, which they have initially guided that it will get moderated, that we need to be careful or mindful in Q3, right? So overall, the setup is good because company is growing 45 to 50% growth, and therefore this high P is justified. So currently, this ILD Exclusive is loss making company, but they're targeting that by FY27 this could be PAT positive, right? So the consolidation could be potentially like bring pressure on this particular company, जो ये करना है इनको EBITDA पॉजिटिव करना है, बट नियर टर्म जैसे नियर टर्म Q3 में ये थोड़ा सा कंसोलिडेशन हो सकता है, बट ये सब आई थिंक market has factored in all this the negative thing about this company, and therefore the setup looks positive at the moment for me. But let's track this company closely. Now moving on to the next company, that is Tekera Tech. Again, this company 40% growth, consistent, 24 crores of the revenue they have reported. It's a very small cap company. Uh, then EBITDA growth is impressive, and then EBITDA margin is also improved from 2% to 19%. PAT is exponential increase in the PAT with PAT margin of 5.70%. Now, if you see FY26, they guided revenue growth of around 30 to 40%, and in FY25 they closed the year with 27% growth. Now in first half they did almost around sorry, so the first half is like 30% of the revenue comes from the first half and the remaining 70% comes from the second half. Definitely H2 is better for the company. And also on the EBITDA level, they are saying that in first half they did almost in the range of 18 to 20% EBITDA margin, whereas in second half the EBITDA margin is going to get improved with 20 to 23% EBITDA margin improvement. So these are the two positive points which are coming from the Takeda Technologies, and therefore expected sales comes around 56 to 60 crores and expected PAT between 3.5 to 5 crores, assuming 5 to 6% of the PAT margin. So what is driving this actually the growth is that the proper utilization of the 5 axis machine is happening there, and their entry into the flying parts which they started production for the aircraft, or basically Indian Air Force is actually a driver for this particular company. So you can pause this video to understand the business model in detail here. So basically they are like supply, they provide various tools for commercial and defense aircraft system. They do the designing to delivery, so complete product setup they provide, electromechanical integration of the various parts they provide, and also important thing is engine overall, that is very important aspects in the in aircraft. So that also being done by this company. So overall good business model, but and also it is getting portrayed in the numbers also. So FY26, if you calculate the forward P on the annualized basis, it comes in the range of 76 to 96, with a growth of 40 to 45%. Again, high growth engine and high P is justified valuations, although they are risks, but looks appears justified because you have to see into the future. And in the future, if this company in the second half does well, then these valuations look cheaper basically. So second half is going to be better, and this is a setup where there is high growth and high P kind of classification which is appearing for Takeda Technologies. All right. So, anyways, a good set of numbers for Tech. Let's move on to the next company, which is Axiscade. This is also an interesting company. 300 crores of the revenue they almost put up in Q2 FY26, almost like 13% growth year on year. EBITDA growth is 42%, PAT growth is 91%, with improvement in the EBITDA margin and PAT margin, which is going up to 7.6%. All boxes ticked. Now, what is happening here? This company is into like there are two domains basically this company is operating: core domain and non-core domain. So core domain is like aerospace, defense, and semiconductor, which involves PCB assembly also. Now this core domain is expected to grow at around 40 to 45%. Now I think more than 75% of the revenue comes from the core domain, and the non-core domain, which involves heavy engineering, auto sector, and energy, which is actually degrowing by -9%. So majority of the revenue is attributable to the core domain, and that core domain is expected to grow at around 40 to 45%. So that's the bottom line for the Axiscade. And in Q1 they did in the similar lines. In Q2 again they did almost so in the first half I'm talking Q1, Q2 they did almost around 300 crores. And in first half they did almost around 543 crores of the revenue, which is 45% of the total revenue projected. So the remaining revenue, which is 55% of the revenue, will come from the remaining half, that is second half of FY 2026. So if you see here, the defense in the core domain, it contributes 38% of the revenue, aerospace 30%, and then the semiconductor 11%, and the remaining is non-core. If you see, they have guided that they used to be a service-led company. Now they want to become a product-led company. So this product mix is changing, and right now product stands around 38% of the revenue, whereas services 62%. And this particular thing is going to change in the upcoming quarters. Now, guidance they have given is like 40% year on year growth for their core domain, and second half will see the accelerations, and 1 billion mark they want to achieve by FY30. So expected PAT comes around 990 to 100 crores, assuming sales of around 1200 crores. So 1200 crores का sales with growth rate it's basically 16% year on year on the overall revenue, not on because last time I think we considered this core revenues only, but that core revenue has to be given weightage because non-core revenue is actually declining and there is nothing you can actually attribute in the valuations from the non-core revenue. So if you see here, expected PAT around 90 to 120 crores आ सकता है यहाँ पे, and forward P of around 66 to 72 from the best to base case. Growth rate, it used to be it was growing at around 9% in the previous year. Now it will grow at around double, that is almost double, like 16%, whereas the core domain is growing at around 40 to 45%. So I'll give more weightage onto this 40 to 45% number to the core domains basically. Now, so this is again high PE, high growth company. Uh, I would say growth on the overall company level is not that high as compared to other companies, because other companies are growing at around 40, 50 plus. This one is like 16%, but still the numbers looks positive. The direction is positive actually, and that's what we are looking for. We are not looking for here comparison on the basis of absolute numbers, but we are looking on the basis of where the direction of the company is. So the direction of the company is positive since it is growing from 9% to 16%, so that is positive. So changing product mix and the core revenue growth, that is the positive point for this company, and this numbers looks positive. So this is all about Axiscade. Now moving on to the next company, which is this Unimec Aerospace Manufacturing. Did almost 62 crores of the revenue. There is no growth at all in Q2 numbers. EBITDA growth is negative, EBITDA margin is declining, PAT growth is also negative, and hence EPS growth. So what has happened previously, this company has given a guidance of around 40%. I think in the Q4 FY25, they guided that full year they will do around 40% of the revenue. And that's why I was tracking this company closely, that yes, 40% of the revenue, it will be more than what they used to grow. And but what has happened basically, if you see here, that in Q2 FY26, they yeah, sorry, they revised the guidance to the lower side. Actual number is not given in the con call, but what they're saying is that basically they are facing headwinds from the US exports tariffs, and there is a tariff impact, and the customers are deferring the orders. They're not picking up the orders, basically they're delaying the orders, and therefore if you see, there is no sales growth in the Q2 FY26. So customers are basically shifting strategy from built to inventory to build to order, which is conservative kind of strategy by the customers. They're following a strategy where whenever there is a need, then they will only place the order. They don't want to build any inventory, and that's why this company is facing an issue with respect to the sales. And therefore management is saying that they won't be able to achieve that 40% growth, but it's not practical, and therefore the growth guidance has been revised, and that is the negative point for Unimic Aerospace here. Now so there is no valuation exercise here. You need to just track this company. Whenever this company ups the guidance, that will have to follow. So this is one negative point for this company, that they haven't factored this US tariffs, and now they are facing the problem. Now let's move on to the next company, which has done exactly opposite to what Unimec has done. So this is an interesting story. This is the last company of our from the defense sector, but this is the interesting and turnaround kind of company. If you see, they posted a negative growth, that is minus 28%. Okay, EBITDA growth negative, EBITDA margin declining significantly by 7%, right? From 19 to 20%, 12%. PAT growth negative, PAT margin negative, APS growth negative. Nothing is ticked, right? But still this company is interesting. Why? Let's look at that. So ये जो this company is like MTAR. Now MTAR is into the clean energy systems, like clean energy, nuclear power component supplier. Then fuel, they manufacture the fuel cells, like they call it hot box. Then they're into the hydropower, wind energy, and battery energy storage system also, and aerospace and defense. So these are the four five verticals which I have explained here. Now, if you look at the Q1, let me just first discuss the Q1 story here. All right, so let me just uh, yeah, there's some issue with the Excel. Okay, so Q1 is not still coming. I don't know what is the issue with this Excel. Anyways, so if you see Q1, they Q1 का जो revenue था, it was like 22% up from the previous quarter. So Q1 was good quarter. EBITDA margin was also improved there, along with the PAT margin. So they got good operating leverage there. And what they have said is that at the time of last video जो मैंने बनाया था, I said that this company is moving from 16% to 25% growth, sorry, because their guidance for 3 years is like 25%. Okay, so that was the positive point with increase in EBITDA, which will stabilize at around 21% and PAT of around 7.8%. Now, at that time in Q1, the order book was around 900 crores, and I wrote here that another 800 crores of order could be added from the nuclear segment, like, and therefore the in the next 1 or 2 quarters, I written this that they will revise the guidance. So I put question mark here. Right. Now let's look at the Q2 numbers now. So Q2 is temporarily dip in the financial performance, right? So this happens in every company, but significant strategic order inflows are there in the Q2, and aggressive guidance. That means company has revised the guidance. Now why there is a dip in the Q2? Prolonged customer negotiations over the external tariff issues and strategic built up of inventory. So these are the 2 points which are temporary as per the company. That means what, they started the negotiation on the tariff went well with the customers, and therefore company is very confident, and they have revised the guidance to upside. So let's see that. So guidance initially given was 25%. Now the guidance is 30 to 35%, which is very, very positive point for this company. Robust order inflows scheduled for execution, and 900 crores is the revenue which they're looking for this year. Okay, now we'll talk about another 800 crores shortly. So the closing order book is around will be around like 2800 crores by FY26, and company is expecting strong second half. That means what, they are expecting more than 2 times sales in the second half of that FY 2026. So these are all positive points which companies reporting or making statement here. So clean energy, they will do almost around 340 crores in the second half. Then fuel cell expansion capacity they're increasing from 8,000 to 12,000 units by FY26, and 20,000 units by FY27. I'm sorry. So there is a tariff impact which was there in the Q2. Company has successfully negotiated with the customers, and the impact of the US tariff has been completely negated. Civil nuclear power, this 800 crores order are still expected by the end of FY26. That's what company is saying. Therefore, I think company has factored in this 800 crores of order in the 2800 crores closing order book, which I believe. And aerospace defense is also, they will execute almost around 100 crores of worth of orders in the FY26, and they also into the new vertical, which is oil and gas, which I think requires a capex of around 90 crores, which will be operational by the June 26. That's what they're saying. So on and all, very positive outlook, in spite of having a bad Q2 FY26. This is a fantastic setup, because Q1 was good. Q2, they absorbed the tariff impact. Now they are good to go in second half, right? And therefore, if you see the forward P, 79 in the best case and 115 in the base case, and I am saying that best case is the likely scenario here. That means what, P is 79 on lower, and expected sales of around 900 crores with expected PAT of around 102 crores. with EBITDA of around 21%, and PAT in the base case is like 70 crores, which I've considered worst case scenario, I would say, and 102 crores is the best case scenario, with PAT margin ranging from 7.8 to 11%. So that is the number expectation from MTAR. What I'm seeing, actually, I may be wrong here, but the commentary looks very positive here, and therefore the positive point for MTAR is that upward revision of the guidance, which is point number one, which is to be taken into the account. That means what, second half is going to be absolutely fantastic for this company, and this is a high PE, high growth company, and the good setup actually uh, in the defense sector. So all in all, we are good on MTAR. Then we are good on Axiscades. We are also kind of positive on Tech Technologies, Apollo Microsystems, and Rossell Techsys. So these are the 4 5 companies which are doing good. And if you want to rate this company, then I think Rossell Techsys should take the crown, because this is the absolutely growing at around more than 53%. And then I would go with MTAR Technologies and Axiscades because of their changing product mix for the good, and this MTAR being a kind of story where guidance has been revised to upside. So these are the interesting points from the defense sector basically. Now, bonus two companies we'll discuss, and we'll end this video. So the first company is Coforge, which we discussed last time. I made the video on this one, since Coforge has acquired the Signity, and there are cross-selling opportunities for Coforge, and therefore this synergy could play out, and that's what we are seeing, that they did almost like 4,000 crores of the revenue in Q2 FY26, which impressive 32% growth. Now this growth story is consistent. I think last year, last quarter maybe almost itna hi growth percentage tha, if I'm not wrong, in the range of 30 to 31 to 30%. EBITDA growth is also impressive, that is 59%, and EBITDA margin is stabilizing at around 14%. PAT growth again 86%, so they are getting on operating leverage here, with improvement in the PAT margin from 7.7 to 10%, along with the increase in the EPS growth. So all the boxes ticked for Coforge. Company post acquisition of Signity is doing good. Now, the Signity merger is expected to be completed by December January timeframe, and the engine has already started firing basically. So in the Q2, they received some fresh orders of around 514 USD million, which comes around 4600 crores, and they also secured 5 large deals in the Q2 FY26. In and in almost 10 in first half of Q2 FY first half of FY 2026. So in FY25, just to compare, they secured orders of around they secured deals of around 14 deals they secured in FY25, but in first half of FY26 they did almost like 10. So they are already running ahead of their deal number basically. Order book, total order book stands at around 1.63 billion USD, which translates into almost like 15,000 crores. And they added new clients also, 9 new clients. Again, the one parameter, that is the IT attrition rate, which is an important parameter, which is to be considered in evaluating the company here. So the attrition rate is very low, lowest in the IT industry. That is interesting point here. EBITDA guidance is 14%, and expected sales, which last time also we discussed, comes around 15,000 crores. Expected PAT 10% of that value, 1,500 crores. And this is the business model. I mean, the revenue split I have given here: travel, transportation, hospitality, then Americas and banking, and then insurance and emerging markets. So Americas is the highest contributor here, which is 57.9% of the revenue coming from that particular vertical, and it is growing well with 30% growth. Now forward P comes up to be 37 to 40, right, with a growth rate of around 29 to 30. So reasonably valued. I think it is the best setup in the IT industry at the moment, and this synergy is playing out well, and therefore this is a winner here, I would say. Then moving on to the next company, that is Prefab. Now this is engineering based company which manufactures basically the prefabricated building materials, and they make the and they provide, I think they provide they operate in the space of engineering with the turnkey solutions. They build and they hand over the projects with the engineering prefab materials, so building material. So they almost did around 434 crores of the revenue with 62% growth, 85% EBITDA growth, 107% PAT growth, impressive operating leverage with both improvement in the EBITDA margin as well as PAT margin. Now, this is highest capacity utilization which the company has observed across all the plants. That means around 80 to 90% of the capacity utilization, which is great actually. Order book stands at around 920 crores, which can be executed in the next 7 to 8 months. So you can already uh, see the run rate here. And first up, they did almost like 650 crores of the orders they booked actually. And first half revenue is almost around 7 to 9 crores, and second half it is expected to be 700 to 900 crores. So FY26 revenue is expected to be 1600 crores, which is like 46% year on year growth. Now, from which sectors this company is receiving orders? Is basically receiving orders from the solar, renewable, semiconductor, FMEG, warehousing, auto industries. Like notable orders are from Premier Energies. Now, this particular company we have covered when we discussed the solar sector in detail, and we said that this company needs to be tracked as because this company is going in a positive direction. So keep in mind that. And uh, already explained about the business model, that this company is manufacturing the pre-engineered buildings, prefabricated solutions for all these industries. Now, what is the USP of this company is that their execution timelines. Whenever they take any projects, they execute that projects in a 40 to 50% less time as compared to the conventional RCC structure. The company has turned cash flow positive, and this high utilization is already there, which is 90% utilization. Therefore they are also into the process of debottlenecking, where they could unlock another 5 to 10% capacity. Right, so that is one. They are also into the capacity expansion, brownfield and greenfield capacity expansion. Therefore runway is actually good. Company is doing capex. Companies is also forecasting good guidance here. So if you calculate the forward P, it comes out to be in the range of 18 to 20, just 18 to 20 forward P, with a growth rate of around 25. Sorry, growth rate which is going from 25% to 46%, which is impressive because last year it used to grow at it has grown at around 25%. Now this year it will grow at around 46%. Therefore the pace of the sales growth is going in a positive direction, by the expected PAT of around 160 to 178 crores. So this becomes a low PE, high growth engine, and therefore this company is clearly undervalued in my opinion. It's not a buy and sell recommendation, but just a I'm just putting a fact here, which you can revalidate, and then think of this particular company. So FY25 growth, 25% growth, which is moving in 46% growth tangent. And capex for the expansion is also planned, which will add up into the FY27 revenues. So this is all about positive stories for the last two companies, EPACK Prefab and Coforge. Both are solid. Then we discuss this defense sector. So this is all about today's video. I'll see you in the next video with another set of companies, where we'll discuss similar kind of companies where which are posting good results, which are posting bad results. And thank you for watching, and do subscribe this channel, and please share with your friends also. Thank you so much.